David Nelson, Chief Strategist at Belpointe Asset Management, is with me. Good to see you, David. Thank you so much for being here. So we talk about tailwinds, headwinds. How are you feeling about the market right now, especially because we have the Fed tomorrow? How important is that? Tell me a little bit what's going on in your mind.
Well, we're marking time today because we do have a Fed decision coming up. But generally speaking, when earnings are going up, and they are, and rates are going down, and you're not in a recession, stocks can push higher. That's the good news. The problem with all of the above is we've lost one of the legs of the stool, and that's, of course, valuation support. And I'll be the first one to tell you that valuation, it's a lousy timing tool. Don't go there. But it may not be the holy grail, but it is a compass, and it's important to have a plan B.
So when we think about the market signals or what you're watching for, when do you start to feel better or worse? Do you want to see something from the Fed or hear something from the Fed tomorrow to give you a signal on what to do next?
I think we all want to see rates go down. The Fed has been too restrictive for too long. Right now, markets are pricing in maybe a 3% Fed funds rate about this time next year. But the pace of which it happens and the reason for which it happens, if it's coming down slowly, and the earnings estimates are continuing to go up, that's probably good news for the market. If they're doing it because the employment data is starting to deteriorate, and right now I don't think a lot of us have a lot of confidence in the data that we've been getting, that's a different story. And then of course the R word comes back into play. So I don't want to see that.
Yeah. And what about a name like Oracle? I mean, does it tell a story for investors like you, shareholders, people, or how about regular folks who are now, you're seeing a lot of new investor interest, retail investors. What do you tell them about a name like Oracle?
Well, I'm going to sound like sour grapes right now because I sold my Oracle shares last month in advance of this quarter. I think it tells two stories. One, the growth is off the charts, but they're extrapolating forward 70% annualized growth in a division. In an industry that's still pretty young, and a lot of that market cap move that we saw that day, they were up $300 billion on an intraday basis. A lot of it was based on a $300 billion order from OpenAI, which, by the way, still doesn't make money. And then when you look down beneath the surface, they're bleeding cash. They're negative free cash flow, likely to be that way for the next couple of years. So at the very least, it should give you some pause. Looking out 5 years is pretty tough to do in a pretty dynamic market.
Look, I'm sure you made some, even selling last month. I appreciate the perspective, but I'm sure you did something right because even last month we saw it trending higher, June, July, August. So it did get, up to, I see it up to like 220, 240, So, I mean, you must have done all right. So profit is profit. So congratulations to you. I know you didn't wait for 345. That happens. How about Datadog? What about Datadog? Is this a name you think has potential? How much? Are we talking 5%, 10%, more?
I think it could go a lot more than that. I think what you have to look at in the software space right now is the earth is shifting under our feet. A lot of the old models are challenged because the legacy players are pricing their services, software as a service, by the seat or license. Now, what I like about Datadog is this is like it's a mission critical application. It's like air traffic control for the internet, but their pricing model is different. They're pricing by workloads, projects, even data consumption. And that's what a lot of software companies are going to have to do if they're going to navigate the new AI era.
Understood. And then we have SLB, used to be Schlumberger in the energy world. Tell me a little bit about that story.
Well, it's a legacy story. Oil services, cheap, no-growth company, down 70%. That's how everybody looks at the name. But this is not your grandfather's SLB. This is an embedded artificial intelligence play. They partner with NVIDIA here, and their digital services platform, which I think is called Delphi, that goes a long way towards enhancing well yields and even in exploration. So it gets a 12 times multiple right now with a 3% dividend. I think that multiple is going to expand pretty significantly.
Understood. And last but not least, in your stock picks, you have MCOR. Why MCOR? Why now?
Well, it's one of the smartest ways to play the data center build out without actually owning a chip maker. This is an engineering and construction services company, so it's an asset-light model. So they don't own the factories; they're just managing the projects. And if they manage those projects well, They don't have any of the balance sheet risk, and they get a lot of the upside, and it still trades pretty cheaply. It's just above a market multiple. So I think size it accordingly. It's a small company, but it's one we like a lot.
Yeah, it sounds like you really have a variety there. When you go from energy to, you have a variety of names there. You're not in the Mag 7 jumping on board there, sort of touting one of those names.
Well,
why not?
We're all along there. We're all along the Mag 7. I am too.
Right.
The question is, that can't be the only thing in your book because we don't know what we don't know. And that's that plan B. You need to have something else in your portfolio. These are great companies. But for me to come on air and tell you to buy a company that's up 100% in the last 12 months, kind of hard to do in here. Extrapolating forward what we saw in the last 3 months to the next 3 months is probably not smart.
And then what about something that you may recommend to folks to wait or stay away from? What would that be?
I think we can find almost every sector offers something right now. I would say probably in the software space, maybe the most challenged right now because the business models are changing. A lot of the legacy players, like I said, that are pricing on that perceived model, it's a changing dynamic. One thing we know about AI is there's likely to be less employees out there. If there's less employees, there's less seats, less people to sell to. So a lot of these names that look cheap in software may be cheap for a reason.
Understood. David Nelson, Chief Strategist at Belpointe Asset Management. Nice to see you, and thank you very much.